The global economy is heading into choppy waters, and Europe seems to be right in the middle of the storm. With soaring energy prices and mounting geopolitical tensions, the European Union, EU, is staring down the barrel of an economic collapse. China, a country that has often played the hero during global financial crises, won't be swooping in to save the day this time. So, what does this mean for the rest of the world, especially the US? Ukraine's war has led to a crisis in Europe. Households and businesses are grappling with skyrocketing energy costs. The ECB has attempted to tweak the situation by cutting the interest rate for the third time in the year, this time reducing it from 3.5 to 3.25%. This does look like an attempt to control inflation, but in actual sense, it only goes on to show how bad the situation has become. Euro lost 1% of its value to US dollar within a week of the cut. This is a big loss for a country that relies heavily on energy imports. Europe's economic challenges stem from energy costs. Before the Ukraine war, Europe got most of its gas from Gazprom, but that is no longer the case. The EU now has to pay exorbitant prices for liquefied natural gas from Qatar and the US. The price of industrial electricity in Europe has soared above 170 euros per megawatt hour, way higher than US and China. Gas prices have followed suit and are now more than 2.5 times above US prices. As Europe's economic leader, Germany has forced most industries to shut down, including power plants, due to a surge in energy costs. Nations like France, Italy, and Germany are seeing a ripple effect with their economies weakening, an increase in unemployment, and a depreciation in living standards. This in effect is causing other industries such as chemicals, metals, and plastics to also suffer. The ECB is doing everything it can to mitigate the risk of an economy meltdown, even going as far as to psychologically prepare for as if we are on the verge of the second Great Depression. The problem? These financial measures are like putting a band-aid on a wound that needs surgery. Lowering interest rates might buy some time, but it doesn't address the structural issues plaguing the EU's economy. Germany, which happens to be the largest economy in the European Union, is in worrying circumstances. Growth estimates are grim, with an average growth rate of just 0.3% expected through 2026. The country's economy is being milked dry with expensive LNG imports, and the increasing debt due to the subsidization of energy prices is stunting growth. For example, subsidies for electric vehicles, EVs, have been slashed, further impeding progress. Without affordable energy, Europe is struggling to attract the kind of investments needed to revitalize its manufacturing sector and boost economic growth. Europe's energy crisis isn't happening in a vacuum. The war in Ukraine, ongoing tensions in the Middle East, and volatile oil production are creating a perfect storm. These geopolitical challenges make Europe's reliance on imported energy even riskier. Morgan Stanley predicts that the ECB might lower interest rates, but without addressing the core problems, this looks quite dangerous. Financial policies alone can't fix what's broken. The EU has spent around 650 billion in subsidizing energy for its industries and consumers, but the hidden cost exceeds this amount. For France, the metric is approaching 6% of the GDP, bearing a heavy deficit. Unlike the US, which benefits from the dollar's reserve currency status, the EU doesn't have the same fiscal flexibility. The growing debt burden not only limits the EU's ability to maneuver, but also raises the risk of a sovereign debt crisis in more vulnerable economies. There was a time when China would come into the picture with huge subsidies or trade contracts to bail Europe out. This time, however, it is not the case. China is trying to recover its economy. The Chinese government has approved a 600 billion stimulus package that aims at promoting consumer spending and also aims to rejuvenate its real estate sector. Instead of boosting international trade, China is prioritizing internal stability. This strategic shift means Europe can no longer rely on China as an economic lifeline. The trade activity that existed between Europe and China has somewhat worsened. From 2022 to 2023, China's exports to the EU decreased, and imports from Europe also experienced a big decline of about 20%. However, Beijing is now concentrating on the improvement of their domestic brands and industries, making it more difficult for Europe. This division is in fact the continued pattern that is witnessed on the global stage, where countries are now edging closer to self-sufficiency. For Europe, this spells trouble, as it loses a key trading partner. Europe's automotive sector, once a global leader, is now feeling the heat. Competing with Chinese EV manufacturers like BYD has become nearly impossible. Chinese automakers produce electric vehicles at a fraction of the cost, making it hard for European giants like Volkswagen and Mercedes to keep up. In fact, their market share in China has plummeted from 25% to just 14%. The high production costs and energy inefficiencies in Europe only add to the challenges. Beyond energy costs, Europe's overly complex regulatory environment is also a major obstacle to economic growth. Businesses often face over-regulation, which hurts innovation and makes operation extremely hard. Streamlining these bureaucratic processes could help foster a more dynamic economic environment, encouraging both domestic and foreign investments. However, this requires political will and coordinated efforts across the EU's member states. Instead, a more robust but contentious approach might be to reach out to Russia again to restore gas imports. Gas imports from Russia via Nord Stream pipelines allowed the European countries maintain energy prices that were lower than those in the United States. Their plans to invest in other energy sources like solar and nuclear are valid, but such initiatives take time to be implemented. In the short term, reviving energy ties with Russia might be the fastest solution to restore the industrial competitiveness, but it comes with a lot of political and ethical dilemmas. The European Union's economic woes transcend the region and permeate the global economy. Economists around the world cannot overlook how significant the EU market is, contributing to about 17.7% of the global GDP. The repercussions of the dwindling industrial activities in Europe is felt all the way across the international trade and supply chains. Considering America's economic problems, the situation in Europe is only going to worsen. Financial fixes, according to many experts, won't resolve Europe's problems on a deeper level, nor will it resolve certain systemic issues that are in urgent need to be addressed. These include establishing access to energy sources that are cost-effective as well as sustainable, changing the way regulations are done, and restoring the industries. Without structural changes such as these, Europe runs the risk of further compromise on the global arena. While this scenario for the future is not a rosy thing to look forward to, it isn't entirely without glimmers of hope for Europe to get its act together. It is likely that investing in clean energy technology, making easier governance, and increasing innovation could assist the area in regaining its edge. This, however, would need combined efforts and strategies over extended periods of time to accomplish. Europe's leaders have to face the reality that solutions of this kind, single-step solutions, cannot be the way to do business. Comprehensive reforms are the only way forward. But the question remains, how will Europe navigate this crisis without external support? What do you think? Can Europe find a way out of this mess, or are we witnessing the start of a broader economic downturn? Let's hear your thoughts in the comments below, and make sure to like the video and subscribe to the channel.